Bitcoin just crashed, and the market is in chaos. But did you know that the fear of missing out, or FOMO, can lead to impulsive investment decisions? Research by Kahneman found that people feel losses 2x more intensely than gains. This can cause investors to sell low and buy high, resulting in significant losses. A recent study by the Harvard Business Review found that 60% of investors experience FOMO. This can lead to overinvesting in trendy stocks or assets, without considering the potential risks. For example, the rush to invest in Chinese EVs may be driven by FOMO, rather than a careful analysis of the market. The fear of missing out can also affect everyday consumers. With the rising cost of jet fuel, airlines like Delta and JetBlue are increasing their prices. But do you really need to book that premium flight, or are you just worried about missing out on a good deal? Research by the University of California found that people who experience FOMO are more likely to overspend. But there's good news. By recognizing the signs of FOMO, you can take steps to overcome it. For example, taking a step back to assess your investment goals and risk tolerance can help you make more informed decisions. A study by the Journal of Behavioral Finance found that investors who take a more rational approach to investing tend to perform better in the long run. So, how can you recognize the signs of FOMO? One key indicator is if you find yourself constantly checking your investments or feeling anxious about missing out on a potential gain. Research by the American Psychological Association found that people who experience FOMO tend to have higher levels of stress and anxiety. Another sign of FOMO is if you find yourself comparing your investments to others. This can lead to a never-ending cycle of trying to keep up with the Joneses, rather than focusing on your own financial goals. A study by the Journal of Consumer Research found that people who compare themselves to others tend to be less satisfied with their purchases. But what about the role of social media in FOMO? Research by the Pew Research Center found that 70% of adults use social media, and that social media can amplify feelings of FOMO. For example, seeing your friends' investment successes on social media can create a sense of pressure to invest in the same assets. So, how can you avoid the FOMO trap on social media? One strategy is to limit your social media use or take a break from platforms that tend to trigger FOMO. Research by the University of Pennsylvania found that taking a break from social media can reduce feelings of anxiety and depression. Another strategy is to focus on your own financial goals, rather than comparing yourself to others. Research by the Financial Industry Regulatory Authority found that investors who have a clear understanding of their financial goals tend to make more informed investment decisions. But what about the role of emotions in FOMO? Research by the Journal of Behavioral Finance found that emotions can play a significant role in investment decisions, and that investors who are able to manage their emotions tend to perform better in the long run. So, how can you manage your emotions and avoid FOMO? One strategy is to practice mindfulness and meditation. Research by the University of California found that mindfulness can reduce stress and anxiety, and improve emotional regulation. Another strategy is to seek out diverse perspectives and advice. Research by the Harvard Business Review found that investors who seek out diverse perspectives tend to make more informed investment decisions. But what about the role of experience in FOMO? Research by the Journal of Behavioral Finance found that investors with more experience tend to be less susceptible to FOMO. This is because they have a better understanding of the market and are more able to manage their emotions. So, how can you gain more experience and avoid FOMO? One strategy is to start small and gradually increase your investment portfolio. Research by the Financial Industry Regulatory Authority found that investors who start small tend to be more successful in the long run. Another strategy is to educate yourself about the market and investing. Research by the Securities and Exchange Commission found that investors who are more educated tend to make more informed investment decisions. But what about the role of technology in FOMO? Research by the Pew Research Center found that 80% of adults use mobile devices to access financial information. This can create a sense of constant connectivity and amplify feelings of FOMO. So, how can you avoid the FOMO trap on mobile devices? One strategy is to limit your use of financial apps or turn off notifications. Research by the University of California found that taking a break from mobile devices can reduce stress and anxiety. Another strategy is to focus on your own financial goals, rather than constantly checking the market. Research by the Financial Industry Regulatory Authority found that investors who have a clear understanding of their financial goals tend to make more informed investment decisions. But what about the role of community in FOMO? Research by the Journal of Behavioral Finance found that investors who are part of a community tend to be less susceptible to FOMO. This is because they have a support system and can share knowledge and experiences. So, what can you do today to avoid FOMO? Take a step back and assess your financial goals. Practice mindfulness and meditation to manage your emotions. And seek out diverse perspectives and advice to make more informed investment decisions. By taking these steps, you can overcome FOMO and achieve your financial goals.